Our first speaker, I'm actually going to is someone, Charlie Bilello, who's got about 1 million followers on social media. He's known as the chart guy. He's got a chart for everything. He's absolutely unbelievable at research. I know a lot of you follow him. He's a chief strategist at Creative Planning. And I know some of you are familiar with the podcast I've done with Jonathan Clements. We still do that every month. It's a very short podcast on some topic, but I do one now every week with Charlie as well. It's called Signal or Noise, and we're going to do one live in front of you together here over the next 20 minutes. So please join me in welcoming Charlie Bilello to the stage.
All right. Everyone hear me back there?
They can.
All right.
You only had 5 seconds of walk on. I had like a whole dance, dance thing.
You did a good dance. So here we are, Peter. Welcome everyone. First live edition of Signal or Noise. And Peter and I tried to really separate the signal, what's important from the noise, what's not. And there's a lot of noise out there, but today I really want to focus on just the signal. But let me just first give you a little backdrop and behind the scenes in terms of Signal and Noise. It usually consists of me spending days putting together charts and themes and thinking about it, and then I send an email off to Peter. Peter, check this out, and then we'll get to the recording. I say, Peter, did you look at it? No, I didn't. Are you good to talk about it? Yeah, let's just roll. And that's the way we've done it. We haven't done any re-recording. It's one shot. I figured let's do the same thing today. You might have taken a look at a few of the slides, but let's just roll with it. So first 10 episodes, we focused on a lot of noise. Right? We're just bombarded every day with noise from sell in May and go away. I know that's one of your favorites. Don't fight the Fed. All these things, these headline news. Remember the debt ceiling?
Yep.
Now that's gone. But today, let's talk about the signal. Let's talk about the investor's journey that every investor takes, and this is what I like to call the long and winding road to wealth. And does that long and winding road mean anything to you, Peter?
We're both Beatles fans, and so we're going to use a Beatles theme to go throughout this episode,
Perfect.
Which will be great.
And where do you rank the Beatles in terms of all time?
Number one greatest band of all time, number one song of all time, Here Comes the Sun, Beatles, everything follows the Beatles.
Okay, there we go. I definitely say top three. The only maybe exception would be Zeppelin in terms of just the pure musical talent, right? I mean,
that should have been your walk-on.
Put Page and Plant together and Bonham on the drum. It's hard to beat that, but Beatles are up there, no question. So what is the long and winding road to wealth? Well, it's a journey we all take, right? It's not a straight line. There's ups and downs. And when McCartney wrote this song, he's talking about the Beatles, how there's ups and downs throughout their career. And every investor really faces that. And I think this chart of the S&P 500 ETF was the first ETF. I can't believe it's now 30 years old. Yeah. That's kind of crazy. But if you look at this, and I told you back in January 1993 when this ETF came out, that if you put $100,000 into that ETF, that 30 years later, you would have 1.5 million. What would you say, Peter? You'd probably say, sign me up, right?
Yeah, I think that's the thing about the S&P 500. If you look at the straight line of the chart, or any index, you can do this with the international index, the emerging markets index, they take their turns outperforming. But if you just looked at the straight line linear version of it, you would say that's the greatest investment in the world. But the story behind this graph is the tech bubble, 9/11, the 08-09 crisis, Trump, Obama, Biden, all the politics that go into everything, COVID. And every single one of those is very traumatic. 34% drop, 44% drop, 53% drop. And every time we're in it, we think it's the end of the world. But at the end of the day, this is a reflection of the economy. And if you believe that 5 or 10 years from now, the price of everything is going to be a little bit higher, this is eventually going to follow. And people just, anytime we're in the middle of the turmoil, it's so overwhelmingly intense because it's real time, it's minute by minute, day by day. It's very hard. Even if you go, on this thing, it's just a blip to be a couple of years. Well, that's hundreds and hundreds, 800 days of listening to negative news and not seeing the market cooperate. But it always eventually cooperates. The economy eventually expands. You eventually have natural inflation and the market follows.
So the lesson is you have to accept these ups and downs. But a lot of people will ask, well, is there a straight line path? Is there something, let's say, that's easier? And the answer is there is. It's called cash. You know exactly what you're going to get. It's never going to go down. And this is really front and center for a lot of people today. They're asking about cash. In 2022, we had the worst year for the stock market since 2008, worst year for the bond market in history. And then you have just simple, boring cash is up. And not only is it up, but now you can get over 5% on your cash. So you're hearing this phrase, cash is king. Why isn't cash king in the long run?
And we have billions of dollars in cash management. It's usually for institutions that need to have money paid out to their if it's a university or a charity, they need to have money paid out over the next few months. But in general, cash is an absolutely horrible investment, not just because it's taxed at the higher rate and the yield is low, but also because while there are brief periods of time where it outperforms. So it's really easy to look at a 6-month period and go, oh, cash earned 4% and the stock market was negative. The issue is we have no advance notice of when the stock market's going to be positive or negative. It can be very, very bad economy and the stock market's positive, anticipating the recovery. Because we don't know that timing, we have to play the odds. And what are the odds? The odds are that cash is always going to earn a small amount, 1% to 5%, whatever it is. But with stocks are going to be positive 3 out of 4 years. We just don't know when those years are. So we can't look at cash in 1 year versus equities in 1 year. We have to look at cash over 10 years against equities over 10 years. And when you do that, the odds are over 95%. You will be better off in stocks. And there's nobody in this room that's making decisions that are based on 5 years. Even if you're 80 years old, you're looking at having this portfolio to go on a very, very long time. And you need to be thinking about how to stay ahead of that over the long run.
Right. It's always, you say it's always good to zoom out. And so if we zoom out and we look at any 20 or 30-year period, cash has never beaten stocks. And this is that 30-year period from the start of that first S&P 500 ETF. You have the S&P 500, almost 10% per year, cash at 2%. And nobody in here thinks in terms of percentages, right? That doesn't mean anything to any of us. We think in terms of dollars. So that same $100,000 investment back in January 1993, well, you have 15x your money in the stock market, and cash, you don't even double your money. Yep. So stocks, you're doubling your money roughly every 7 years, and cash over this 30-year period didn't even double.
And if we do after tax, it's much more dramatic because with cash, you're paying income taxes, which is the highest rate you can ever pay. And if we're using stocks, you're not paying any taxes unless you sell. Right. And if you sell, you're paying the lowest tax rate that there is.
Absolutely. So the question that everyone should be asking here is, how do I get this higher return? What's the trade-off, right? There's no free lunch, and you're getting this higher return because of that winding road, because of that volatility, because of those times of trouble. So the next stop, let it be, Peter. And you know the line from the song, when you find yourself in times of trouble, Mother Mary comes to me.
Can you sing it? Can you sing?
I could. Next time I'll bring my guitar next year, and we can have a little duet. That would be fun. But what McCartney's talking about here, he said that he had a vision. His mother's name was actually Mary, and she died when he was 14 years old. It was very traumatic for him. It was very hard on him. And one night, she came to him in a vision, in a dream, and she's essentially saying to him, Paul, it's going to be all right. Let it be. Things are going to be okay.
I can't believe I was today. I did not know that until you just said it. I thought this whole time it was a religious.
Jesus' mother. Yeah.
Yes, that's right.
So people have asked him that. He says, interpret it the way you want. Right? But
it's about my mom.
That's the actual thing that came out. Yeah. So as an investor, what's the parallel here? Well, there's always times of trouble. There's always a storm cloud ahead. We know it's coming. This year has been relatively calm, historically speaking, but it's coming. Something is coming in the future, and we need these words of wisdom. We need these reminders that it's going to be okay. So what do you tell people, Peter, when you have these volatile times? What should they be thinking about? What should they be doing, and what shouldn't they be doing?
You should be really grateful for the volatility, because the reason stocks outperform bonds over the long run is what's called the risk premium. And the risk premium is this idea that you get rewarded for the risk. But the risk is really not risk of loss. If you're diversified, a diversified portfolio has always, through all 140 or so corrections, bent but not broke. It's recovered. We know what the general outcome is. The risk is really the volatility. That stomaching the 34% drop during COVID, which was the fastest 34% drop in history, or stomaching the 53% drop in 2008, 2009, which was the second biggest drop in history and one of the longest recoveries in history after the Great Depression, that's why you get the extra return. So you have to embrace that. If there was no volatility, more people would buy stocks. There'd be more demand than supply, or supply than demand. You would have basically the returns compressed to be more bond-like. And so you really want to hold through those markets, only doing several things. One is rebalancing into weakness, and the other is taking advantage of the tax trade.
We're going to talk about both of those.
All right,
So maybe you did look at it.
I did look at it.
All right, good.
In front of this many people, I'm going to look at it in advance.
Good.
I think this was probably the first financial podcast recorded in front of this many people. So I was going to look at them in advance for sure.
Someone Google that. We'll see. There might be a Guinness Book of Records that we're making here. Yeah. If not, next year we'll do it at Arrowhead Stadium.
But that's because no one records a financial podcast in front of anybody.
The bar is pretty low, but still, I can't see the back, so that's pretty good. So the biggest mistake investors can make, right, is turning that short-term volatility into a permanent loss. And this is a chart that's instructive, right? Because we see that flows go the opposite of future performance. Whenever there's a big decline in markets, you see these massive outflows, 2020 being really the most recent example, everybody running for the exit. It's going to be the next Great Depression. What words of wisdom were you whispering during that time period when you saw people were just running for the exits, they were losing their heads?
Yeah, I think what's unfortunate is people stomach so much of the market, the day-to-day, the corrections, but then when it's at its worst, you see the most net outflows. So the largest net outflows in history happened the actual week of the bottom of 2008, 2009, and the actual day before the recovery of the stock market drop in COVID. So you think about going through all of this pain, and then when things are at their very worst, you exit right before the recovery, which creates permanent loss. And so the key for investors and what we were doing, and as many people in the room know during COVID, is we were buying. We're actually taking the very opposite point of view that there is going to be a day when people go back to Disney World. There's going to be a day when people go back to McDonald's. And as long as you can accept that, then you should invest. Now, sometimes I remember having a conversation with somebody who said, no, the world is over. No one's going to Disney World again. And I said, well, maybe if you really believe that, then you should sell. Yeah, but if you can just get to a point, no matter what you're going through, where you can look past and go, okay, at some point, people are going to go back to buying candy bars and iPhones, then that should tell you to stay invested, stay calm, and it will work itself out.
Absolutely. And you just have to remind yourself also that it's normal. And the first time I did a chart like this, it surprised me a little bit. If you look at every single year, so it's not just limited. We talk about the bear market, but there's volatility every year, this year included. And if you go back the last 100 years, the median drawdown during a year is about 13%. And you say, wow, the long-term returns for stocks is only 10% a year, and I got to stomach that each and every year? And the answer is yes, right? There's really no way of avoiding it. Sometimes that storm is just a little bit of rain. Sometimes it's a hurricane, and we don't know in advance what it's going to be. We just have to kind of accept that and let it be.
Yeah, the poor investor can't handle it, which is most people just can't handle it. And I think it's not a criticism. It's usually just someone's not educated enough about the markets to stay calm. Good investors can buy and hold through it. The great investor gets excited about it. I mean, it really takes a lot. But you're great. You're a great investor when people are panicking about whoever the president is, and it gives you that opportunity. That's when you know you've arrived on the other side of investing.
Yeah, I think Naval said that the difference between an investor and a speculator is the speculator gets nervous when things are going down that they own, and an investor gets excited. So you get really excited, I'm sure, when you have these big bear market declines. Yeah. The last 30 years have had a ton of them. What was the most difficult one for you personally, or talking clients through? Was it the financial crisis? Was it 9/11, the dot-com bubble, housing bubble, pandemic? It's a lot to choose from. What would you say was the most difficult over this period of time?
I think that COVID was actually remarkably easy because everyone was so worried about dying, they weren't worried about their stocks, right? And by the time everyone figured out everyone wasn't going to die, the stock market had recovered. And so it was so swift, it was so fast, and it was so stunning, and there was so much that was happening that we had a massive amount of, for those that were clients at the time, there was a massive amount of communication. I mean, like I think in those 25 days, there were 10 letters and 3 webinars, and it was just an incredible opportunity for the disciplined investor to place trades. 08, 09 was very different. I mean, you're talking about something that went on for 6 months of terror, right, where
Yeah.
people think the financial system is really, truly going to collapse. Overwhelming. I remember seeing a statistic that if you watched CNBC and Fox Business, that almost 100% of the stories every day were negative. They didn't have anyone that would go on and say it was going to be okay.
Yes, they ran that Markets in Turmoil
Right.
special, which I would tweet out every day, showing the historical track record and how poor is it. But they literally ran it every single day for a few months.
And what so Charlie's talking about is every now and then when it's really bad, CNBC will actually change their headline to Markets in Turmoil. So Charlie,
Special report.
he created a graph.
Sell.
He created a graph that if you buy every time CNBC had a Markets in Turmoil special, the market was up how much on average? I mean, it was
Yeah, double digits.
Double digits.
100% of the time, a year later, the market was positive. They hate that.
Yeah, 100% of the time. 100% of the
Charlie,
time.
stop showing that.
Ultimate buy signal was Markets in Turmoil. So 0809 was hard. The longer it goes, the harder it is.
Yeah, so we have this concept, and this is what we tell people, kind of ride it out, things will get better, but that's not our instinct. We all have this fight or flight response, and when our portfolio is going down, we want to take action, we want to do something. And we give permission to do a few things. One of them would be rebalancing. So I know you're not a fan of rebalancing just for the sake of rebalancing. Let's say do it every month or every quarter. What's opportunistic rebalancing, and how did that play out in 2020 to investors' advantage?
So rebalancing is the idea that if your portfolio is, say, 70 stock and 30 bond, just to make it very simple, a lot of people can just hold, and everything will be fine if you hold. But when the market really has one of those severe drops, that's the one opportunity you get as an investor to really make a change that has historically 100% of the time paid off. And that is when the market goes down, say during COVID, if you were supposed to be 70% stocks and in COVID, it would have dropped to 55% or somewhere around there. If you rebalance then, when the market's really plummeting, you don't wait for the end of the year. Well, when the market recovers because you've invested more in stocks, you've invested more in the recovery, and you will be able to outperform the expected return of that portfolio because of that. So that's what the investors get excited about, is adding to their positions when they're under severe distress by panic selling. And very rare, you don't have too many opportunities to do this over a decade, but when you do, it gives you the chance to jump ahead of the crowd.
Absolutely. And it's not to say you could time the bottom.
Right.
It's just to say the long-term odds are in your favor.
Right.
And if you have that opportunity, take advantage of it.
Yeah, I explain it like with a mortgage. If you have a mortgage that's at 7% and mortgages go to 6%, you should refinance. We don't know where the bottom is, but you should refinance. Then if it goes to 5%, you do it again, and you do it until you get to the bottom. And that's the way we would approach this. You rebalance, the market keeps going, you just do it again until we capture wherever the bottom may be.
Right. So number 2 would be tax loss harvesting.
Yeah.
Not a lot of people may be familiar with this, but it's something you can do, again, opportunistically, and not just during big declines. I know creative planning is doing this now, using technology to do this all the time to book those losses for securities, and then it can offset future gains. You have a sale of a business, sale of real estate, and it could be meaningful. For some people, it might be small, but for some people, it could be very meaningful. So what's creative planning doing in terms of tax loss harvesting?
The easiest way to describe this concept is to forget about the stock market for a second, and let's just assume you had $500,000 and you went and bought a duplex to rent out to somebody. But there's a cul-de-sac and there's 2 duplexes right next to each other. They're exactly the same, except one's blue and one's red, but otherwise exactly the same. You pay $500,000 for the blue one, you move in, or you rent it out, but then COVID happens, and the duplex is no longer worth $500,000. It's only worth $300,000, and the one next door is only worth $300,000. You sell your duplex for $300,000, which sounds really stupid. You went from $500,000 to $300,000. You have a $200,000 loss. You tell your CPA you put the $200,000 loss on your tax return, but 1 second later, you go buy the duplex next door, which is also $300,000 because we're in a crisis and it's down in price. So you bought at $500,000. You sold at $300,000, and you went next door and bought at $300,000. Well, what happened after COVID and with every recovery? Prices recovered. It didn't just come back to $500,000, it's worth $700,000 today. All these properties are up. So if we look at the end game for that investor, they put $500,000 in, and today if we said, what's your duplex worth? Well, it's $700,000. But on their tax return, they have the $200,000 loss, and that's the concept of tax harvesting. When a stock goes down, if Exxon goes down 10%, you sell it and you buy Chevron, and they both come up together. You have gains in the real world, but you have losses on your tax return. It's the only free pass in stock market investing where the tax law is set up in a way that allows investors to sell one asset and buy another one, even if they perform very similarly. And we take advantage of that when the opportunity arises as well. The idea is over the cycle of a market, you want to have gains in the real world, but you want to have losses on your tax return.
Okay, so let's talk about the positive side. Your favorite song,
Favorite
Here
song.
Comes the Sun. And George Harrison, right?
Yep.
Just most underrated Beatle, for sure.
Easily. Wrote their best song, yeah.
Yeah, something, great song. I think Sinatra called it the greatest love song of all time. So that's definitely top 10 as well. And we know that the sun is out there. I think the sun rose today around 6:55. I'm sure you were up already, Peter.
I was not.
Okay,
not
good.
at Janelle.
Sleeping in. And every day we know when the sun is actually going to rise, but as an investor, we don't know when that bear market's going to end. We don't know when things are going to get better. But a lot of people think you can time that bottom. And I think this chart really illustrates why you probably shouldn't, because what happens following that bottom over the next year and the next 3 years? What tends to happen in the market?
The market just doesn't recover. This is what the great reward is for the smart investor, is the market recovers at a rapid pace. So there's this feeling people have, oh, my portfolio is down 20% because we're in a tariff war with China, and it will take 4 years to get back to even if I only earn 6 or 7% a year. But that's not how the market behaves. It behaves like a rubber band or a slingshot that you pull back. Whenever the cloud is lifted, the recovery is swift. So if you think about the tariff war, well, when we reached an agreement, the recovery was within weeks. Think about COVID. We're all going to die. Wait a second, we're not all going to die. The recovery happened within a few weeks. So the second that the cloud is lifted, and think about it like a sandwich shop that has a roadblock in front of it. If you have a sandwich shop and you hear a roadblock is coming, no one wants to buy the sandwich shop. And if this roadblock is there, still no one wants to buy the sandwich shop. But if somebody says the roadblock is being removed next week, now I want to buy the sandwich shop because I know people are going to be able to get through to the road to go there. That's how the stock market behaves. As soon as they see that the roadblock is going to be moved and they have a general idea of when it's going to happen, the recovery happens instantaneously. That's why you get that rubber band effect, and that's why you see you don't just see recoveries, you see double-digit recoveries, the market outperforming its historical norm when that happens.
Right, so when you're in a drawdown, this is a chart you should be paying attention to. It's the idea that we think is it's going to continue, right? Object motion is going to continue in motion, and we're saying that loss is going to become bigger and bigger. But again, zoom out, and actually the nice thing as a long-term investor is the bigger the drawdown historically, it's great to buy at all-time highs when the news is great. And all-time highs are typically followed by more all-time highs, so that's not a reason to sell. But if you have extra cash sitting on the sidelines, you don't need this money for 20 years, well, here's your opportunity. The bigger the drawdown historically, the better the forward returns over the next 20 years. And if you have a 50% decline, there's going to be a lot of bad news out there, but the future is brighter. So let's talk about the S&P 500 here and what people are thinking today. We have this incredible return, right, over 1,400% over the last 30 years. And a lot of investors, Peter, they coming to us with two questions because of the last decade. Number one would be, why do I need to own anything other than the S&P 500? The U.S. economy is stronger than anywhere else. It's safer. The stock market in the U.S. has done far better than any other country over the last decade. Why do I need to own this other stuff at all?
You know, it's interesting. So obviously, if you look at 2000 to 2010, I believe that's what that chart is, right? That you basically have a period of time where the large cap U.S. stocks, which included Apple and Microsoft and all the companies that drive things, earned 0% over 10 years. And I remember clients would tell us, I mean, it's been a decade, Peter. You know, can't you figure out that everything's moved overseas in India and China, and of course you stay diversified, and you have to still have the U.S. as the anchor of the portfolio. And then in the last decade, we saw the opposite. We saw large cap U.S. outperform everything. Coming into this decade, there was only one thing that BlackRock, Vanguard, and Goldman Sachs agreed on. They don't agree on anything other than controlling the whole world. You know, they control all of it, 70% of investments or something crazy like that. But they all expected over the next decade that international stocks would outperform the U.S., emerging market stocks would outperform the U.S., and small stocks would outperform large stocks. And they have been 100% precisely wrong so far this decade as the U.S. continues to outperform. But if we really look at the U.S., What's really outperforming is 5 to 7 large cap tech companies. And if you extract them from the S&P 500, the S&P 500, which is large US, is very much behaving like other indexes.
So that brings me to the second question here, which is, why should I not just own those big four?
Right.
We all use these in our everyday lives, right? Apple, Microsoft, Google, Amazon. They've far outpaced everything over the last decade. It's hard to see them not being leaders in the future. And what would you say to that? And obviously this your illustration tells the story.
Yeah, your illustration tells the story, which is no matter how formidable the companies at the top seem, they eventually give way to a new set of companies. That's capitalism. It's how it works. It can be a competitor, it can be a change in technology, or it can be regulatory. The government can come in and break things up or change things. And so you really can't have all your eggs in one basket. Now, I will say this. Most creative planning clients, the anchor of their portfolio is large cap US, which means the 5 biggest positions of creative planning clients are Apple and Microsoft. I'm not against having the exposure. It's a very, very significant exposure for our clients. Is the biggest stock. When you look through the portfolio, it's their biggest stock positions, but you just can't go all in because eventually they'll rotate someday.
Years might change. And I guess the best example this year would be NVIDIA, right? And if you had thought 5 years ago, I'm just going to own the biggest stocks, well, you wouldn't have owned NVIDIA. Right. Now everyone's including that and assuming that it'll be a leader going forward. But the cycle changes. We have IBM on here. They used to call that Big Blue. Maybe it's Smaller Blue. But I think, was it because they had blue computers or just the concept? Not really. I think that might be it. Someone in here might know the answer.
Someone does.
Yes. So Big Blue today is, I think, the 88th largest company in the world. If you look at General Electric, that was the biggest company in the world in September 1993, so 30 years ago. Today, it's not even in the top 100, right? And no one would have thought that back then, right? AT&T. And so the list goes on, and that's why you diversify. Well, let's go to investor attitudes and getting better. And if you're watching the news or reading the daily headlines, you would say things are getting worse. Almost all of the short-term news is negative because that's what drives clicks. But as an investor, Peter, you probably should have the opposite viewpoint. And I would argue, and we're going to show some reasons why, that's a rational viewpoint over a long period of time, to be positive, to be optimistic, to be hopeful. And I would argue you have to do that because it's the only way you're going to stick with that portfolio during those times of trouble, right? So why is the future going to be better than today if we look at earnings? So 20 years from now, do you expect earnings to be higher or lower than today? If you say lower, you probably shouldn't invest in the stock.
Right. If you think companies are going to make less money today, if you think you're going to go to Chick-fil-A and it's going to cost less, if you think you're going to go to McDonald's and it's going to cost less, you should not be a stock market investor. But if you're looking over the long run, you expect prices to go up, earnings go up, the stock market eventually follows.
Right. So long-term prosperity, and this is something you've talked about, I talk about a lot. Everyone should try to seek out books that talk about this. 2 of my favorite are Factfulness, great book, just summarizing why everything is actually so much better than it was 100 years ago, 200 years ago. Another one would be The Rational Optimist. I don't know if you read that by Matt Ridley. And what are the trends you're talking about here in terms of education, healthcare, lifespan that have really improved over the last couple of 100 years because of the Industrial Revolution, technological revolution, scientific revolution?
Yeah. I think this is not just important about feeling good, but as an investor, it's very important to have this view. I think that if you look, when people go, oh, I wish I lived hundreds of years ago, for most of mankind's existence, 95% of people did not know if they were going to be able to find any food or water that specific day. Average life expectancy was a few decades. Until World War II, there was no such thing as this idea that you were growing up, you were a teenager and you were getting married and there was no such thing as all this other stuff. You were going to work, and I love people who complain about things, on their iPhone, right, which has more technology than Apollo 13 had, and they're complaining about how bad their life is, you know what I mean? And it wasn't that long ago that you basically died by getting eaten alive by something, or died in a war, or from famine or disease. I mean, we live in incredible times, and why it matters to investors is if you look at what drives returns in the long run, it's innovation and technology and demographics. In other words, are we advancing as a society? And I think if you look today, we can look at the invention of fire and the wheel and the Industrial Revolution, and then we look at now, like thousands of years from now, they're going to look at the internet age and the artificial intelligence age as things that really transformed quality of life for people, and the advances that are happening in healthcare and with technology now are happening at a rate that they've never happened before. So we have that building block. The other building block's demographics, which means, are there going to be healthy people that are around to buy stuff? And we are now living longer. We are actually living better, at least to a certain age. And we have 1.2 billion people coming out of poverty all over the world. And you know what? They want to go to Walmart, and they want to buy Nike shoes, and they want to buy phones, and they're consumers. So if those are, we know those are the two building blocks of advancements. And so if we can get past what's on TV and we look at charts like this and see where the world is heading, it makes it easier to do the zoom out that we talked about at the beginning and make smart long-term decisions.
Right, but weren't the good old days in the 1950s? That's what we hear all the time. It seems like every generation thinks about when they were a child, that was a better generation than today. But if you dig into it, today is actually the good old days as compared to even the 1950s, which were pretty good, but still most people are much better off today.
Yeah, much better off. And people, you know, if you look at the average home, the average education, literacy, by every single measure, we're seeing improvements and things that impact the economy.
There wasn't even retirement, right?
Yeah.
The concept of retirement in the 1950s really was non-existent.
Right, Social Security was set to pay out at 62 because that was the life expectancy. It was designed that when you got it, you died that day, right? That's why it doesn't work. That's why it doesn't work today, right? And so they've never adjusted the life expectancy to match, you know, when the Social Security payout is. Now you get it, and your life expectancy is 20 years. It's very different.
Yeah. So last point on that, technology, and you covered it a little bit, but we talked about this on one of our podcast episodes. But why is AI not going to be a problem? Why are we not all going to lose our jobs? Why is it actually going to probably help things and make things better?
I think when we look at all the advancements in technology, we all think we're going to get replaced. And some jobs do get replaced. But what happens is you see the work week compress for people, you see the quality get better, and you see people move to higher paying jobs. So just think about, Blockbuster goes away because of technology, but what does the consumer get? The consumer now, for the price of going to a movie, has billions and billions of dollars of production that they can watch whenever they want in their bedroom, right? Is that better than going to Blockbuster, and better than going to the movie? We can argue about the fun of being with a crowd, but there's no doubt I can do things when I want, and I've got more choice for a lower price. But there's still a business providing that. It's just no longer AMC to the same extent. It's not Blockbuster, it's Netflix. And that's what we see across everything. The companies will come and go, but the quality to the consumer gets better. They pay less, and they do it on their own time, and you have a better outcome. The iPhone's the classic example of that. It replaced so many things, right? Not just the phone, but the Atlas and the computer and the flashlight. It replaced 25 different things, but it made it easier for the user, and all those things got replaced for something that was better and cost less and made the life a lot easier. And I think that's what we're going to see with artificial intelligence, because it's what we've seen with every technological advancement in the history of mankind. And so there will be jobs that get replaced, but the outcome is going to be better for the collective good.
You probably can't predict that. It's funny. I was just thinking while you were talking, what we're doing right now, podcasting, didn't exist when we graduated from school. There was no such thing as YouTube. None of that had been invented. Yeah. And there's going to be many things like that in the future. So it's getting better all the time. And let's close it out with the end. And arguably, I can't think of a better way to end like a musical career than this song. It was actually the last song recorded by all four collectively. They each have a solo in the song. And really, the last words that they recorded together were these by McCartney. In the end, the love you take is equal to the love you make. And what does that mean to you, Peter? I think there's a lesson here in terms of everybody. What's important at the end for us?
I think what we're going to hear all throughout today is what you put in is what you get out with your life, with your health, with your wealth. And so all today is going to be about getting more educated, making better decisions to live a better life. And that's my favorite quote from any Beatles song as well.
Good. Yeah. And so how do you use that wealth to enhance relationships in your life? Because we know wealth is about more than just money. And when you say enjoy your wealth, what are you telling people to do?
So you can't come to one of these without me saying this at some point during the day, which is that we want to be the firm that tells you to go spend your money. and go enjoy your life and go enjoy your wealth. And it's very hard for people, and I think we'll conclude with this, it's very hard for people to, the people in this room, you're extremely successful people. You're spending a Saturday when college football is on and whatever else is happening in the world, and you flew in or drove in here to learn about health and wealth and living. That's not normal. None of you are normal, just so you know, that you would spend a Saturday doing this. It's wonderful, though, and that's why you are where you are, because you've invested in yourself and you've invested in your account, and you're the type of person that's disciplined, and probably when you had a 401k, you invested in it every single pay period, and probably with other accounts, you saved and you made good decisions, and then you got to a point where you were in that top couple percent in the United States. And when you get that person with all those incredible traits that made them successful, and it gets to a point where they get to start, and you should be living along the way. There are some experiences that expire, like I like to talk about a lot. Like I tell teaching a guest speaker at a university, and a kid said, hey, I got done talking, and he said, I'm going to skip my trip in Europe with my friends because I'm going to save money. You don't you think that's awesome? And I said, that's absolutely a terrible idea, because that experience expires. You're not going to do it the same way you would do it when you're coming out of college. You got to enjoy things along the way. That's going to be one of the messages of today, but definitely when you have the time, when you're retired, you need to enjoy yourself, especially if the projection says, look, you've got more money than you need. You should be thinking of ways to spend it and enjoy it. And I promise you, if you don't, your kids have no hesitation to enjoy your money. We have, we have trust settlement services at Creative, and when somebody passes away and the kids show up, it is not uncommon at the second meeting they show up in a new car, and they've already hired somebody to put an addition on their house. They have no problem with the balcony view on the cruise. They don't have any reservations about sitting in first class, even though the other seat will get them there in the same amount of time. They have no reservations about any of that. And I never accept as excuses, well, I want to save it for my kids. Well, enjoy giving it to your kids now. It's way more fun, I promise you. Or people who say, I want to pile it all up to give to charity when I'm gone. It's way more fun to give with a warm hand than a cold one, I promise you that. So definitely enjoy your wealth, because if you have a hard time visualizing your kids doing it, it will really motivate you if you think about your daughter-in-law and son-in-law doing what they want to with your money. All right?